Take a look at what's driving the softness in the local markets. I'm joined by Byron Lotter, Portfolio Manager at Vestact. Byron, it's good to have you with us. So let's talk about the Fed and the JSE and the feed through into the markets, because it's been very much a muted response and we're seeing markets slipping back today. Why is that?
Well, I think, we've seen resources come down quite hard, and that's on the back of maybe a weaker dollar and a stronger rand. I think the Fed announcement yesterday was probably one of the most significant we've seen in a long time. Linking interest rates to an economic data rather than a time frame just creates that extra certainty in the market. And it's interesting to see how the Fed can innovate even when interest rates are at zero. So that was very significant. And then, of course, they've changed the Operation Twist, because originally Operation Twist is they were buying treasuries and then selling them, the short-term treasuries to bring down the yield curve. But this time they're still buying the long-term treasuries, but they're not selling, which means that effectively they're printing money and pushing money into the market. They seem to be able to do this because inflation has been under control, and at this stage employment is a lot more important than controlling the inflation rate.
I'm just looking at the Fed's balance sheet. It's sitting at around $2.86 trillion, and it's expected to grow by around $1 trillion next year. And so that just indicates, that's growing over 1/3. The size of the stimulus coming through, but the markets aren't that happy about new money. Why is the question once again, are the markets just not getting that?
Well, that's if they continue doing this program, throughout the whole year.
Yeah.
I think that's the biggest case scenario. I think the market's still quite concerned about the fiscal cliff. Every day you keep up to date and you see what's happening, and it seems to be a big tug of war. Barack Obama seems to have the polls behind him, and that's giving him a much better stand. And I think, the power of the Democrats is a lot better than what it was when they had the debt ceiling issues. So I still believe that we will get a decision. But of course, market sentiments is just going to be shifting as the news from that decision making comes out.
So perhaps, as you say, it's a short-term focus on this issue not being resolved. But let's look into 2013 and where the JSE is going to go specifically, because it's bobbing around these record high levels every day, and most people are bullish on a rebound in resources. Where do you stand right now when it comes to that?
Well, we're still very positive. Lots of people there were a lot of naysayers out there at the beginning of this year. And what happened? We had the Brexit, that fell away. The US economy has been growing nicely. There was no hard landing in China. So I think 2013 is going to carry on with that theme. I saw Jamie Dimon on TV yesterday, and he was commenting that if US policymakers manage to get the tax issues right and sort the fiscal cliff out, the US economy is poised to grow possibly 4% in 2013. With a $15 trillion economy, that's massive. And then looking to add up to 200,000 jobs a month. And you can see where he's coming from. The housing market is a massive stimulant to the US economy. If that starts picking up, they really are poised for this kind of growth. And that, of course, is going to have massive positive sentiment issues around the globe.
So let's look at kind of your gems, some of your stocking fillers for this year, and looking at the stocks that you're betting on for growth in 2013. Which ones would that be?
Well, one of them, I'm still quite positive on the retail sector going forward. Obviously, a lot of the retailers are definitely priced for growth. So you've got to find those little gems that are sitting and looking a bit cheaper. One of those is Hold Sport. They own Sportson's Warehouse and Outdoor Warehouse. And I just think, trading on a forward PE of about 10, I think they find themselves in a very lucrative part of the retail sector. South Africa, sports crazy. We've got the climate. We've got a growing middle class, and as children enter schools, they've got to go and buy those cricket bats and cricket pads. And as people get more health aware, I think that stock is really going to do well.
Why is it so much cheaper than other retailers then?
Well,
if there is so much kind of optimism from your side about the growth story going forward, or the kind of almost investment thesis, why is it being priced at a 10 PE?
It's smaller than the others. It's not as liquid. It pulled back quite a lot because it's quite dependent on the rand. Obviously, with the rand weakening, their imports will increase. So that is definitely factored into the share price. And I think people are still quite skeptical about the retail sector and whether they can manage growing. The earnings can be quite volatile as well. They do mention in the results that when you have a big World Cup year, the earnings are big, and then you have a higher base to compare for the following year. But I think if you're patient with this one, there could be a potential buyout target, and definitely one for the future, and a good dividend yield.
Now, City Lodge has kind of stood out recently. It's had a strong run, came out with a trading update yesterday, earnings expected to be up. Can't exactly remember the number now, but it was a really strong trading update and an indication that business travelers are using their facilities, and of course that's feeding through into the numbers.
Yes, I mean, this is one we've been holding for 2-3 years now and been extremely patient with. They did a massive expansion in 2010 or 2009 before the 2010 World Cup. And then unfortunately, there was a financial crisis, and a lot of South African hotels also increased their capacity. So supply increased. And we were expecting a big revenue increase, but unfortunately, occupancies dropped. Now we're seeing occupancies obviously increasing. They're expecting earnings to increase between 20 and 35%. So yeah, it's great to see, and good for the company, good for the sector, and of course, like you mentioned, South Africa as the gateway to Africa. We should definitely be seeing more business travelers coming in here.
Well, certainly is looking that way, and it is a good signal for where the economy is right now. But thank you so much for joining us. Byron Lotter, Portfolio Manager at Vestact.